From one retail investor to another, this is Trader72. I hope you are all well. Welcome back to my YouTube channel. I am back after 3 days rest. I think the last video I dropped was on Friday. I did two actually on Friday, so please do check them out. But yes, fresh, feeling good. I hope you guys had a great time wherever you went, if you traveled or saw family. I did both. I did a bit of gardening, played a bit of golf. Chilled out on the Sunday completely. It was marvelous. I really enjoyed myself. So now I'm back. I felt like it was good to start the week with a little bit of a video about really what would you do if you were given £10,000 tomorrow? So as a new investor or medium-sized investor of experience, where would you go? Would you do it differently to maybe what you've done last time? I certainly would. So we'll go through that in terms of a process of what I feel is a clear, simple strategy of where to put your money when you first start investing, and a conclusion to this really about whether or not this is something that I feel this might be the right path. Also on the back end of this, I will a little bit of news regarding my portfolio. I have re-strategized my portfolio due to the news of what's going on geopolitically at the moment. I didn't really want to do this, but I felt that it was probably the right time to potentially change it up a little bit. I've pulled out of a few investments that I've made, which means my portfolio now shrank quite considerably. But with a reason behind it, essentially, as you guys all know and well documented about what's going to happen within the next 24 hours in the stock market. I feel that potentially the two companies I will mention I've pulled out of might be getting them even at a better price. Now, risky strategy in terms of that could go either way, and the situation in Middle East could change dramatically one way or the other. But I'll explain that to you guys in a bit, really, in terms of how that might pan out. So, without further ado, let's start this new YouTube video with what would you do with £10,000 if you were inheriting it, giving it, lucky old you, whoever it is, or earned it hard, and how would you go about investing it? Now, there's several ways, and the chart here will kind of show you guys a little bit about how I've broken this down into three parts. Now, it says 2026 bear market, but it's not a bear market at the moment. It's a correction. We're going through geopolitical situations, inflationary background as well at the moment, which is stagnant between where the Feds want to be in America and where it is at the moment, and obviously with oil issues at the moment moving up to nearly $114 a barrel at the moment, certainly will augment the situation into probably more or further inflation. So at the moment, I won't call it a bear market, but this is what my graphics called it up at the moment. But exactly how to invest $10,000 smartly at the market condition. So first step first really is to look at the foundation, which is ETFs. Everybody's talked about ETFs. ETFs are basically big, great pies where you put your money into this group of companies or of indexes, and you invest money on a regular basis, whether it's up or down. So maybe the first thing to start is to take part the 10,000. So maybe potentially, and this could be sliced and diced in various different ways, but let's start with maybe taking 3/4 of the money to start off with. £7,000 allocated to an ETF. Now, ETFs, like I said, are the safe version of compounding your money over a period of time, maybe 10, 15 years, 5, 10, 15 years, or whatever you guys want to do. There are loads of ETF from, obviously, that came Vanguard. It's obviously the one I've mentioned there, which is possibly the most well-known. Obviously, depending on how much it costs to actually invest in that. Obviously, do your due diligence. I am not, by the way, you guys, I'm not a financial advisor. I have no financial background. This is purely what I feel is potentially the way best forward. But do your own due diligence before you make a move on this. So this is purely advisory at this stage, just to kind of teach you guys a bit of a process of what I should have done and what I didn't do and what I, didn't quite work out. So learning from mistakes is that. And it's also about really a clear way for me to explain to you in a very clear black and white way. The whole point of this channel is no jargon, no major big words. This is more about clarity and a simple way forward in terms of investing. So as you can see there from the cursor there, £7,000, and what you call is called dollar cost averaging. Now, this is for some of you who may not know, I'm sure most of you probably do. What is dollar cost averaging? I'm just kind of explaining it to you. So it's, instead of dropping £10,000 in one big lump, you basically put potentially £1,000 every month, regardless of whether the market is up or down. So if you put money in when it's at the highest, obviously you buy as few as shares. If it's at a lower price, obviously it buys you more shares. So you're averaging your cost per share. It basically gives you a margin of safety, whether the markets are up or down in any way. And so basically it kills also the fear of buying into an individual stock, maybe where you may have bought slightly overvalued or undervalued, depending on what you want to do, and it goes through the ups and downs. This is averaging it right out at a certain price. It's almost like putting it into a savings account a little bit and it goes up. Now, that's what a dollar cost averaging means. It's basically averaging your money. Now, it could be £1,000, it could be £500 every month. You put direct debit, and regardless of what happens, you're investing into the S&P 500 or a dividend-led ETF, whichever way it goes. And obviously, that will then smooth things out in that respect. So that's what dollar cost averaging is. So you put £1,000 a month, let's say for 7 months, you're buying the 500 best US companies at 4 to 5% market discount. So that's obviously quite attractive there in terms of that discount there. So that's one way of allocating the first part of your money, really, through a VOO, Vanguard, S&P ETF. There are loads of good ETF, different platforms that I won't mention at this stage, but that is one of them that I would certainly see. Obviously, make sure that the cost of you buying into this are at their best, so you get a good discount, as mentioned there. But if you obviously invest over a period of 5 years, you will make a return. The S&P 500 over a period of 20 odd years has certainly made money for anybody that's bought in at this stage. So, you could average it out and, make a very constant profit on that. Now, the second part of my investment plan is to buy into companies like Visa and Mastercard. I've mentioned them, I think, quite a few times in the past. I'm tracking one of them I own myself in my portfolio, Visa. But Mastercard, two tool booth compounders. Tool booth compounders, it basically, obviously means that they are constantly having an in-stream income. They are like tools, like on the highway. You have, obviously, you pay a certain amount of money along the way every so often, and Visa will pay you are basically compounders. They don't not make money. They are what I would say a safe pair of hands. So if you allocate £1,500 or 750 each, even maybe on each company. So why? Because obviously at the moment it is at a 24%. Both companies are over 25% discount in terms of share price. But every transaction that these companies make, puts money in your pocket. Pure quality, high margin, global moat. Now, some of you might know I like my 4Ms, which is a criteria, which is obviously meaning, moat, management, and obviously margin of safety. These are the 4 criteria, and these companies at this moment have effectively have got all 4 of these in abundance. Now, on top of it, which is quite rare, they are both at discount due to various different issues with the Visa cards, which you guys need to look into. But nothing I would say that would, these are quality companies. They're not going to be replaced overnight. And the question you must ask yourselves is, will the company be around in 10 years down the line, 15 years, 20 years down the line? Yes, they will. Whatever comes up with, transaction, people trying to put capex on the interest rate on the credit card, or European companies trying to replace this credit card, the monopoly of these two, that will always be there. But the moat is huge. As you can see there, I'll just give you an idea. The digital payment volume growth is from 2023 to 2023. It's going to go from $12 trillion to $18 trillion. Who has not got a credit card? Every time you spend money, the merchant gets money, the credit card creams on top. It is just a tool booth. Exactly. So if we're looking at Visa, here we are. So currently Visa is at actually 290, about $300 a share. It's slightly out of date. Currently at 26% discount. The intrinsic price is at 416. So you can tell that over my criteria of 25% that's when you should start looking at investing into a company in that respect. The same happened with Mastercard, 25% discount, currently at 671 intrinsic price. So again, a massive upside of 31%. I think looking back at same for Visa. So as you can see there, really, these two companies definitely may be worth putting some kind of another quarter of your cash aside. Third and final, the value sniper. I like that title. It does tickle me a little bit. I might even put that as my thumbnail title for the day. Now, these are companies that are basically huge conglomerates, huge part of the Mag 7. Always good to have one of them in your pocket. But obviously, at the moment with the pullback on tech, you have to be very careful that you choose the right company at the right price. Remember, guys, it's about the right story with the right share price. And the value of the company is also important. Now, it does give you an example of Alphabet or Microsoft. Growth play companies, another 1,500 quid you can allocate, and that will basically complete your £10,000. Again, both at the moment, discount off its history PE multiples at around 20 to 25%. Now, again, looking at Microsoft, you're looking at 17, it's actually slightly 17% discount. I would suggest that it's probably more than that because it's down to 375. This was grabbed a little bit earlier on last week. So currently it's at 375. So you're looking between 20 and 25% discount there on Microsoft as it stands. A huge upside of almost 50% based on where Wall Street are at the moment. Wall Street's target of 595. So again, you know, these companies are outstanding earners. As you can see there, the PE multiple is currently at minus 22%. So again, there's the AI noise. There's lots of going on with Microsoft, hence why Microsoft down. But again, an opportunity to potentially put some of your money, and not all of it, into Microsoft and maybe kind of sit on it for the next few months. Again, think about it. Microsoft ain't going nowhere. It's an established brand. It's got huge moats. And at the moment, I think it's you know, without shadow of a doubt, a good investment to make, even at this low prices. Now, obviously, with a discount on top, that makes a difference, such as Visa and Mastercard. So that is what I would think would be a great strategy at this moment in 2026 to do with your £10,000. Three quarters of it into an ETF, maybe. The other one in another quarter onto the tool booth compounders, Visa and Mastercard, and a value sniper like Microsoft at a discount of its PE ratio at the moment. Another £1,500 you can allocate to that. So really, this is where I feel. Now, obviously, there's other examples of other companies you guys might want to look into that might be at a great discount. There's many more that I'll be looking at, potentially some even other tech companies like, you know, Adobe, maybe Intuit as well, which I know a lot of people are saying SaaS is going to be destroyed by AI, but some of these companies will survive and at a tremendous discount at the moment. You've also got potentially other tech companies like Uber at a great discount, which again, I did own. I just actually dumped yesterday, but I will buy back in. Again, great company, great fundamentals. Just look for companies that are established, that have got a great history behind them, that will be around. And the question you've got to ask yourself, will they be around in 10, 15 years? From there, track it back to the share price, the intrinsic price, the discount on it, and make sure the numbers make sense. And there's no other issues with current news of any kind that might be affecting the stock price. The main thing is that if you buy at a discount, you will get hurt less than if you buy at an overvalued stock. So that's where I think the situation is at the moment. You can have, like I said, I mentioned a few there. There's the Vanguard SP 500 on the index, QQM, which is the NASDAQ. Obviously, might be worth looking again a little bit more up and down the NASDAQ, so I'd be more careful with that one. And obviously, the dividend fortress, so where companies, obviously, you buy into companies that pay a dividend, which you get, which with an ETF dividend could actually be really good to have as well, as it pays out, obviously, along the quarters of the year. So these are three different variations that you can think of. So That's where we are at the moment with that. So that's the main takeaway. So let me know what you guys think in the comments below, and then we can go from there. So moving swiftly onwards now to what is going on at the moment. Our friend, Mr. Trump.
Where every bridge in Iran will be decimated by 12 o'clock tomorrow night, where every power plant in Iran will be out of business, burning, exploding, and never to be used again. I mean, complete demolition by 12 o'clock. And it'll happen over a period of 4 hours if we wanted to.
Well, there you go. So that's Trump's latest rhetoric on the Iran situation, and this is what the markets at the moment woke up to this morning.
Live from London, this has been Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Oil gains while stocks lose momentum as traders remain wary ahead of President Trump's latest deadline for an Iran deal. The US president ramps up threats to destroy infrastructure if his demands aren't met, including the reopening of Hormuz. Iran rejects Trump's latest proposal.
So that's where we're at the moment with this situation with the conflict. We have got a deadline. The situation, as you can see there, the actual crude oil is kind of running between $112 and $114 a barrel at the moment, and it has been for the last probably 4 or 5 trading days. So the uncertainty, obviously, of the market, some people obviously investing to maybe hedge their bets. Some people are sitting on their hands. So what am I at the moment? Well, I dumped recently the situation that I just did, which is dumped Uber, which I bought at 72.23, and I also got rid of my S&P Global at 433. I bought at 435, so made a minor loss on that of £17, and actually got in the green on Uber by about £5, so really very minimal. Now, the reasoning behind the situation is the fact that I feel that if there is going to be a war, and I feel that potentially, I think the deadline will be passed. I think that the Americans will go in what capacity. I'm not an expert on it, so I can't really judge what will happen. But if there was, I think there will be a slight downturn in the market. I think we're waiting to see which way this is going to swing. It's a very hard decision. I must admit, I mulled over this one for quite a while. I just felt that it would be safe for my account value. And your account value, guys, is what it's all about. You know, your account, what you've got to make sure that you protect it if you are slightly overexposed. And I felt I was slightly overexposed at this moment. So by getting rid of Uber and Visa, obviously, I've managed to get my margin back down a bit, which obviously is a bit more of a protection. Now, by doing that, obviously, if there is a peace process, then the markets will pop, and I will probably miss the actual movement of Uber and both S&P Global, which are both, as you guys know, very much like as companies, definitely investable, and both at very good discount. But where I bought S&P Global at 435 was only at 23, which was just slightly under my criteria. So I decided to potentially wait to see if it falls back maybe to 420, 415, where I really then would be looking at a 25% discount almost, or maybe 410. Uber the same. I think if I could get Uber around the 70 mark instead of the 72, it would give me almost a 50% discount on Uber based on its intrinsic price. So I think if that would happen, then I would be very happy to buy back in, regardless of, you know, what's going on. The market factors very quickly things that happen in the current situation. The uncertainty is about the future, and I think at this moment, once the markets gets used to the idea there's going to be a conflict, I think the markets will eventually bounce, even with the conflicts going on at the moment. There's no doubt about it that this is going to cause chaos in terms of if he does go in tonight with inflation. The crude oil will probably pop well above $120 a barrel potentially if this does happen. Now, question, will this happen? Well, I'd rather balance this out and sit this out at the moment. I have kept at the moment Visa, which is more of a defensive stock, and currently at 303, and you can see they're £120 down. I've also got a crude oil short position, which is not doing too well at the moment, £400 down at the moment. And obviously Adobe still well down on 243. Do not remember, guys, that I've obviously just started this account just recently. So obviously when you're buying into stocks that are distressed, you will be going the red first. Hopefully this will obviously pick up over a period of time. This is what value investing is all about. Waiting for the right opportunity for a bounce. Potentially sometimes you might buy too early, too late, depending. Perhaps they are bought too early on Visa at this moment, but better be in it than not in it at all. That's what I always say. So I think that's kind of where we are. So my portfolio is significantly reduced after the sell-off of Uber and obviously S&P Global, and I have got now a margin. You know, I've also got available cash now to buy back in if needs be. So this is my news for the day. That was what I did. I'm hoping that I'm not going to regret that decision, but as a trader, always better make a decision than not make a decision at all. That's my criteria of how I feel that will be. So sometimes I've learned my lesson that when you don't, you get caught out. So I felt like that was the best time. Yes, if there is a peace process, which obviously we all hope there will be eventually, the market will certainly jump very quickly. If not, then I'm going to presume the markets will go into the red by quite a bit and maybe buy more bargains at the right price. And again, this is my motto, and like a lot of the investors I've listened to, it is all about buying a good company with good fundamentals, quality, with a good management and a good moat at the right price. And if you do, you will make money. So there we go. Just a quick bit of news. United Health jumped again at 300. This is one of my watch lists at the moment. On the bit of good news about the cost, it looks like they've agreed on a 2.8% increase for Medicare. I need to look more into see what that means really. It was at 280 yesterday, so quite a jump there, and a lot of the healthcare companies clearly was up for the day. Excuse me. Quick look out. Nasdaq down by about 150 points. Not really any doubt there. I think people are just waiting and seeing what will happen tonight on the deadline. US 30 down by 309 points. So nothing specific going on. So let's wait and see. As soon as we've got a bit of news, obviously I may well come back and do a quick show just to kind of go from there. I hope you enjoyed the this one about the 10k one. That's interesting. I think that's something that I definitely would have loved to do in the long run. If I maybe could restart again, let me know. Any comments below, please, guys. I've not had many comments to start this YouTube channel. Maybe potentially, obviously, as I'm new, I understand, but it'd be great to get questions I can answer, or pluses or minuses on what I just did there, so I can learn as well in terms of going forward. Criticism is always a good thing. I'm never against it. So please subscribe and like. And this is my first back this week. There will be a lot more this week coming up. I look forward to catch up with you guys, and well, fingers crossed to see what happens next. As I said, I may well be in touch if things happen. So in the meantime, have a great Monday, guys. Speak to you soon. Take care.